welcome to Economics. Bank and NBFC fixed deposit rates continue to climb. Shriram Finance has just opened a scheme offering 9.4% for 4-year FDs. Small finance banks have been hawking their FDs at 8% plus. And banks have announced almost 7.5% rates on their FDs all through August. Is this the peak of deposit rates, or is there a structural issue which is going to keep rates high? Is there a CRR cut needed or some other regulatory intervention to make things easier for banks? I have an elite panel to explain to us. Professor T.T. Rammohan of IIM Ahmedabad, the veteran banking economist and part-time member of the PMEAC. Ashish Gupta, CIO of Axis Mutual Fund, one of the best banking analysts I know. B. Prasanna, the head of global treasury at ICICI Bank, and Samiran Chakraborty, chief economist at Citibank India. Gentlemen, thank you very much indeed for your time. Prasanna, let me start with you. Is the worst over? Are you getting a sense that liquidity has improved and therefore we are not going to see even higher rates?
So, Lata, I think you have to look at this question in two aspects. What's happening to the systemic liquidity and the banking system liquidity that RBI controls at the aggregate level. And from that perspective, I would pretty much say that two things are happening. One is the government is actually building down the WMA balances. So to that extent, that's a release of money back into the system. And the second thing is, as you all know, there is a likelihood of a gradual change in the monetary policy cycle over the next 2 to 3 months. And that is kind of likely to bring a little bit of liquidity back into the system as we go ahead. But the real issue is on the banking system deposits. And from that perspective, I would say that because of a lot of things we have discussed about how mutual funds are garnering money and so on and so forth. Bear in mind that while they don't affect the aggregate deposits in the banking system, they do affect the color of money that comes to the banks in terms of both the duration and in terms of the type of entity which deposits. It actually shifts from households into wholesale, which all requires a higher runoff factor. And you know about the new LCR guidelines. So all in all, I think from a deposit rate perspective, I think the pressure on mobilizing new deposits are likely to continue. And while the general rates in the system and the general liquidity is likely to ease.
Okay. Well, on that point, Professor Rammohan's latest article in the Business Standard kind of clarifies things. Professor Rammohan, if you can just explain, the common chatter is that people are putting money in mutual funds because that's more attractive, giving more returns, and therefore bank FDs are likely to remain neglected and therefore expensive. I mean, money doesn't go out of the banking system. Can you explain the relation? If banks keep on collecting money only in savings deposit, is that a problem?
Yeah, so, this whole debate is not just about aggregate deposit growth, it's also about the composition of deposits. That is material from the standpoint of the bank. How you fund your asset side, what composition, what mix of deposits or what mix of funds you're using is absolutely vital for the stability of the bank. And now, so, you can access deposits through wholesale deposits or retail deposits. You can access deposits as current account or saving account or fixed deposits. And so how exactly you manage this mix has various implications for both the profitability and the stability of the bank. Now, the argument is often made that it doesn't matter if savers choose alternative investments to saving deposit or bank deposit and put their money in mutual funds and insurance products because the money is going to come back into the banking system anyway as deposits. Well, it does come back as deposits, but it doesn't come back as saving deposits or long maturity fixed deposit. So when you give the money to the mutual fund will keep it in the current account, or they will invest in money market instruments. And so this money will return as deposits in the banking system, but it will return as current account deposit or fixed deposit of relatively short maturity. Now, from the point of view of managing liquidity risk and also interest rate risk, this is a material difference. It's not a small thing. And so if it's going to come back as a current account or as a short maturity fixed deposit, then the bank is constrained in what sort of assets it can take exposure to. You can invest only in relatively liquid assets, either government securities or short duration loans, short-term loans. And so if you can invest only in government securities and short-term loans, it's going to impact your profitability. And so you have to understand. So this is.
I take your point. I take your point that and the RBI is also increasing the liquidity coverage ratio on what they call unstable deposits. So they are, although they are raising the money at savings rate of 3% or 0% current account, they are getting much less because they put it in T-bills. But on that point, Ashish, see, I take the point that time deposits have got, an FD has 1 year, 3 years, so some kind of security for the bank. But that is still coming at 7-8%, whereas savings and current is coming at 0 and 3%. So why is it that banks' margins are getting impacted? Technically, cost of money is less. So even if they earn less, margins should not be affected. But we saw that in the Q1, margins were affected. Why?
Okay. So, Lata, before I answer that, I think I'll also like to address this composition issue a bit. Right? So, it is absolutely right that based on the type of deposit, there's a different runoff factor, and therefore lendability of a bank does change basis whether it's a retail deposit versus a wholesale deposit. But I think there is some clarification that is needed. So, for example, if a household invests in a SIP or invests in a mutual fund, right? The mutual fund does not go and keep money in a current account, right? The mutual fund does not go open a short-term FD. Mutual funds, insurance companies are also intermediaries. They go and buy stock, right? And deposit therefore moves from one household who's the buyer of the mutual fund to it could be retail, it could be some promoter. No, it's not a brokerage. The person who's selling the stock.
Okay, it could go to a company.
So and we have seen that even in IPOs, most of the companies have not been raising money. It has been offer for sales, right? So it is the person selling the stock. So potentially it is going to another retail investor who's now selling the stock, or it is going to a promoter. So it's not necessarily sitting in a financial entity, right? And therefore, the composition may not be changing as dramatically as we are presupposing. If we look at the data, and we have data till March 24, in terms of composition of deposits, and you'll see the share of deposits is largely unchanged. So household deposit share for the last 10 years has averaged between 63 and 61%. So that has not changed at all. There has been an increase in corporate share of deposits, but really that's primarily driven by the fact that it has come out of improving corporate profitability. So corporate profitability has moved from 2% of GDP to 5% of GDP. So it is natural to assume that corporate share of deposits has gone up. If we look even in terms of CASA versus total deposits, yes, compared to 2021-22, today CASA share has come down to, so from a peak of 43% for the system, it's down to 38-39%. But you are really comparing from COVID period, from and if you look at the 10-year average, CASA ratio of the system was around 38% only, right? So it is not too different from what we have seen in the long term.
No, the point I want is that for the bank, is this going to be very margin dilutive? Because anyway, savings and current account or CASA is cheaper for them. So why are we bemoaning that, it is not coming to FDs, it is coming to CASA? It should not make a big difference to deposit, to margins, or does it?
No, it does, because whether you deploy money in credit or whether you deploy money in investment, the margin profile is fairly different.
Okay.
So it does make a difference. But I think the bigger impact that banks are seeing is that over the last 4 years, increasing amount of their loans have been linked to external benchmark,
Okay.
right? So these are either the repo rate or the T-bill rate. And what you are seeing is in the past 2 years, when RBI hiked rate, their loan book saw repricing upward, but the deposit cost did not go up at the same pace. Now you are seeing the deposit cost going up when the loan yields are not going up. And in fact, as Prasanna mentioned, if there is a change in monetary stance, if the benchmark rates come down, their actually loan book will see repricing down, while deposit costs may not ease.
Okay.
So that will certainly be on bank margin.
But yeah, I take your point. Liquidity has improved. But Samiran, I want to bring in an altogether different point. See, we have seen many periods, and in fact, we have been running the credit and deposit percentages from 2014 onwards, or even 2010 onwards. There are many periods when credit growth is a little faster than deposit growth, and periods when deposit growth is faster than credit growth. But is this period more sticky because there is one second largest bank, HDFC, which is hungry for deposits? 2, the 2,000 rupee notes were withdrawn last year. And 3, RBI went on a fairly serious tightening spree last year, same time, in August, September, October. You know, they were not creating enough money because they were worried about inflation. So do you think this period is likely to be more sticky and will remain sticky till all this HDFC Bank issue is sorted out?
So, Lata, if you look at the last 25 years credit deposit growth profile, this is the fourth instance where there's been substantial gap between credit and deposit growth. The main hypothesis out here is that credit creates its own deposits and not vice versa, where the traditional thought process has been that deposits create credit. Now, if you believe in this credit creates its own deposits and try to test it with Indian data, you actually find that to be true. The causality runs from credit growth to deposit growth and not vice versa. And if you take that analysis further forward, and just an econometric exercise shows that it takes about 40 odd months for the credit deposit growth to converge. That has been the traditional pattern. So from that perspective, this cycle is halfway through. We are about 2 years into this credit deposit growth divergence. And that's why I don't think it's necessarily very different from the earlier cycles that we have seen. Yes, the HDFC issue might be creating a bit of a short-term problem, but that's not the critical challenge. And it's also true that when this credit deposit growth diverges, there are options available to banks to fill this gap, as we are seeing that the short-term borrowing through CDs, etc., of the banks have significantly gone up. There's been some equity dilution also to bridge this gap. So in my view, it's possible that if we are patient enough, we will automatically see this getting converged. And I would agree with the other panelists here that the composition of the deposit matter. Our econometric analysis shows that as well, that if the proportion of term deposits are relatively higher, then in the subsequent years, the credit growth also picks up. So in this cycle, what we are seeing is actually now the term deposits have started moving up a bit, and that probably should lead to a convergence. And the last point is that if you look at deposit growth in isolation, it's still running ahead of nominal GDP growth. Yeah. So we can't really say that deposit growth is too low in the country.
Oh, that's a very important point. And I take heart of your numbers as well. The deposits were lower than incremental credit last year. It was, I think, 17 trillion loan and 15 trillion deposit growth. But year to date, if you look from April to now, then deposit growth is about 8 lakh crore and credit growth is about 5.3 lakh crore. So already I think deposits are more than credit. Dr. Rammohan, would you agree that therefore the problem is going to get resolved on its own? You know, there is a point that the markets are doing exceptionally well, and therefore we will continue to see a greater preference to invest not in FDs but in some other instrument. So do you think the Reserve Bank needs to intervene in some fashion, say a CRR cut, or even some other regulatory instrument? Harshvardhan of Bain was suggesting that a one-time effort be allowed, allow banks to issue bonds for funding, which can be tradable. Is there some regulatory intervention needed? So I think you're on mute.
Sorry. Well, I do want to address the misconception that this problem is entirely to do with overall liquidity. And the moment liquidity in the system improves, the problem will go away. I'm afraid it won't, because it has to do again with the composition of deposits. So just because aggregate deposit growth goes up doesn't mean that deposits will grow in a fashion that is suitable to banks. Because you can have aggregate deposits going up, and banks will be able to access deposits as CDs, wholesale deposits. But that's not going to help banks at all. The problem is in saving account proportion.
Okay.
Now, somebody mentioned the figure of CASA and said that it hasn't changed much, 41%. Earlier, it used to be around 42%. But there's a point that I made in my article, which is I said, there is an issue about how we are categorizing savings account today, because there are many private banks which are offering FD-like interest rates on saving accounts. So you keep 50,000 rupees, you get the saving bank interest.
Yes.
Above 50,000 rupees, you'll get 6%, 7%. But the point is, if you're offering FD-like interest rates on a saving account, then the saving account loses the interest rate and liquidity risk characteristic of a saving account, and it approximates the liquidity and interest rate risks of a fixed deposit, and it makes a world of difference to the management of liquidity and interest rate risk in a bank. Okay. Now, this has been, I'm sorry to say, this is not adequately appreciated. Okay. But let me just hasten to add, if you give me a minute, that you need to broaden the discussion beyond deposits and go to the aggregate funds. There are many ways in which banks can today source low-cost funds. I mean, if the exchange rate is steady, you can access funds through NRI deposits. You can access funds through ECBs. Yep. So there are various ways. In which, there's also line of credit and refinance available from multilateral and domestic institutions for particular assets. So if you've got microfinance loans, or if you've got renewable energy, you get access to long-term concessional finance.
That's right.
So, so if you're asking me how can banks address this problem, I think they need to look beyond deposits.
No, sir, in the interest of time, the short point you're making is that you don't need regulatory changes at this point in time. Banks have other instruments. I have to take a quick break, and I want more advice from all of you, both on when do you see the problem ebbing? Will it take a year from now, 18 months from now? As well, whether other regulatory things like tax, the very different tax treatment of the two instruments, FDs and non-FDs, needs to be rethought. All those questions after a break. Why are deposits hard to come by for banks, and how long will this high FD rates persist? I've been speaking to Professor T.T. Rammohan, economist Samiran Chakraborty, Ashish Gupta of Axis MF, and B. Prasanna of ICICI Bank. Gentlemen, thank you for your patience and thank you for waiting on. Well, speaking about how long the problem will persist, Samiran, are you confident that it will get over quickly? Because there is a structural attraction of equity markets and it doesn't look like going away. Plus, the RBI's LCR rule also kicks in. So do you think this once, it may take longer for deposit rates to come down or the deposit growth to bridge the gap with credit growth?
In theory, let's understand why we are here, because if you believe that credit creates its own deposit, then the role of money supply is very limited. Money supply essentially becomes endogenous in this. It just has to track whatever the reserve requirement of the banking system is. In practice, what something like a CRR cut might do is that it can increase the funds available with the banks to lend. So to that extent, it can reduce this stress on creating deposits. But we have to understand that at this moment, the durable liquidity in the system is exceptionally high at close to 4 trillion rupees. So any additional durable liquidity creation through CRR cut, etc., would be difficult. So I suspect that we will go back to this discussion not about just the deposit growth and credit growth mechanically matching with each other, but also the fact that whether the composition of the deposits over time is changing in a meaningful way or not. So to me, while I'm more confident on the former, that the credit and deposit growth gap will normalize, there is still some uncertainty over whether in the long term the composition would be in favor of the banks with more retail deposits, etc.
Okay, Ashish, what is your sense? Any regulatory intervention needed? I mean, a time for giving such huge tax sops to equities was there. But now equities is a roaring asset class. Isn't the difference in taxation too large? Or is there any other regulatory intervention, if not legal?
So, Lata, as I mentioned earlier, I don't believe the deposit challenge is because of money moving into equities at all. So, as I said, these are really transfer payments. And actually, seller buyers are both what is classified as retail, right? The change in composition that we have seen is actually share of government deposits come down. This has been both on account of government moving to a just-in-time payment system, keeping larger balances with RBI, and of course, pre-election some slowdown in spending. I think Prasanna mentioned that, or Samiran mentioned that government balances are coming down and with RBI. So I think that will feed into better liquidity into the system. So in that sense, I don't think there is much regulatory intervention needed. I think, of course, what we don't need is further tightening of the LCR guidelines because that will just compound the problem.
Okay. Well, quickly, Prasanna, your take again. The question I began with you. Do you think this once it's going to take even longer for the deposit rates to fall? For exactly the reasons, government is in just-in-time spending mode. They're spending only after the states show that they have spent, and other reasons, HDFC Bank and other reasons.
So, Lata, there are actually two problems very quickly. One is the aggregate deposit problem, which RBI keeps referring to at multiple times. I think that will sort out over a normal time frame that Samiran and others were talking about. But the problem of the composition of the deposits, that unfortunately are not going to change too soon if this kind of incentivizing financial savings into other type of products are going to continue. And hence, what our view has been is that there should be some kind of a parity in terms of tax structure for deposit rates between other fixed income products and deposits. There should be reduction in small savings rate in line with the movement in G6 rates. And we also hope and believe that RBI will not increase HQLA requirement beyond what is already there, which we feel is on the higher.
I guess answers can be sought on several quarters, but let's see what the authorities do. Thank you very much. Out of time, but very interesting discussion. Thank you, Professor Rammohan, Prasanna, Samiran and Ashish for a very interesting conversation.